Well, I think it's happening right now. One of the fascinating things about last night, Tanvir, was the market's response to the news, and particularly Jerome Powell's statements. It was really quite extraordinary. Initially, when we saw the FOMC statement, the markets rallied sharply, the Dow, S&P, and the Nasdaq, and then they turned around and rolled over, and the Nasdaq accelerated into the close. And in fact, as you know, in the last several hours, Nasdaq futures continue to trade very, very weak during our time. So I think, in fact, that we are seeing a kind of a bursting of the so-called speculative mania, or another way of putting it, perhaps, is that the fever has finally broken. And what we saw, particularly through August, of course, was this extraordinary increase in the purchase of call options, particularly short-dated call options, by retail investors. And, in fact, others, major institutions jumping on the bandwagon. And I think we got to a point where my personal view is that the valuations of some of these mega-cap technology names in the United States just became way, way far too stretched. So in a technical sense, we saw that first 10% correction in the Nasdaq. We've seen a bit of a rally. I now think we're going to see another 10% decline in the Nasdaq. So looking at from peak to the bottom of this move, about 20%. And also looking at the technical analytical framework, I think the September 1st second high in the Nasdaq was actually the fifth and final wave of this move. And we're now seeing the third minor wave down in terms of the Nasdaq.
Jonathan, it's interesting, though, that you said some valuations have gotten far ahead of themselves. I mean, you've also highlighted Tesla, that in your opinion, you see as the poster child of irrational exuberance. Not everyone agrees, of course. But if we get that further correction, I mean, would you take the opportunity to have more differentiation in the tech space, to go back into some names that you think perhaps unfairly have been brought down?
Well, that's very interesting, Nancy. I think this is the time when institutional fund managers in particular should be looking to actually rotate away from some of those, very, very expensive tech stocks. Tesla, as you say, I think is the poster child of irrational exuberance, and we don't even need to talk about valuations, which are through the stratosphere. But it is the ultimate manifestation, in my view, of this speculative mania. But the bottom line is, you've seen some of the cyclicals beginning to perform a bit better. Financials, of course, are the other side of this trade. You've had this huge rally in growth stocks, and say financials, as an example, have been incredibly depressed. So perhaps even start nibbling on some of the more depressed, better value kind of cyclical plays in the market. The other thing, if I can just be brief, we're seeing data that there's going to be a massive rebalancing of portfolios, particularly diversified portfolios, because equity markets ran up so strongly in August, and some institutions are calculating that there's approximately $200 billion of equities that need to be sold prior to the end of the month, which is the quarter end, of course, because equities have so significantly outperformed bonds. So many institutional investors are beginning to say, hang on a minute, our individual stock exposure to some of these names, whether it's an Amazon, an Apple, or a Tesla, or a Facebook, is now somewhat, right up against our risk limits. And so not only do you have very stretched valuations, you now have portfolio construction and allocation constraints that start coming into play. And then, Nancy, we've got the big one, a really big one on the horizon, which we're all very much looking forward to, is, of course, November the 3rd.
Very much.
So if you add all that together, you've got I think market's going to be very, very volatile here.